Quick overview. Spire, which I'm going to be talking about this evening, has investment properties in 4 of the western provinces. Western Canada is where we really want to be. In 5 of the southern states, which John talked about, and in Seattle, Washington, which is another part of the Pacific Northwest, which we really enjoy. What I'm going to talk about this evening, I'm going to give you a brief history of Nicola Wealth Management's investment in real estate, talk a little bit about the team and the approach, talk a little bit about the principles that we use to evaluate opportunities, look at 4 very brief case studies of properties that we have selected and one that we have rejected, talk about the challenges and the opportunities that we face in the marketplace, and answer the question, why invest in Spire? Not from my perspective, but I talked to some investors that are invested in Spire and some of our financial planners that are fee advisors and said, why do people invest in Spire? So that's at the end if you can hang with me for the next few minutes. Brief history. John, Nicola being the smart guy he is, looked at asset classes 10 years ago and said, we need to have income-producing real estate as part of our asset class. So he needed to acquire expertise and knowledge. He went into the marketplace, talked to Dave Crosby, Jane Thorne from Crosby Property Management, Mark Hanna from Avis & Young, and together they said, let's buy some individual limited partnerships real estate. So they began with the property that John talked about, Westbrook Shopping Center. Between 2000 and 2005, they acquired 4 properties, 3 retail centers, and 1 package of self-storage properties. In 2005, I joined the group and took what had been an informal group and created Nicola Crosby Real Estate Asset Management Limited, which is the asset manager for the properties, and created Spire Real Estate Limited Partnership, which improved upon the structure of the individual limited partnerships. We saw some things that weren't really working as well as they could. An individual limited partnership doesn't provide diversification. And we saw diversification as an important risk management tool. So by creating a master limited partnership, we were able to put multiple properties into an investment. Through a master limited partnership, we were also to create a tax-efficient structure that enabled us to invest in Canadian properties and in American properties without having to complete American tax returns. We also enabled people to add money and take money out of the limited partnership. Often when you have a single-purpose limited partnership, what happens is you have to stay in for the life of that investment. In order for it to work, you have to sell your asset. We find some assets that we really don't want to sell. We want to keep them for the long term, and the structure that we've created goes on in perpetuity, so it enables people, when they get tired or they want to split their estate, they want to sell, they can sell, but we don't have to sell the assets. So it's a structure that works for us. 2008 to 2010, when the market was in turmoil, we closed, we didn't accept new money. Again, like John Ferresi says, we don't have to do deals. We only do deals when they make sense to acquire assets. 2010, we opened up Spire for new capital. We also opened up Spire US. We'd started acquiring US assets with John Ferresi and Venterra back in 2007. We dipped our toe in the market. We started acquiring US assets, but we were buying them through Spire LP. In 2010, we were finding that some investors really wanted to have some concentrated US exposure. They liked what was happening and developing in the US. They wanted to buy US assets with US dollars and get US distributions. So we enabled people to buy into Spire US LP with US dollars. That started in 2010. So where we are today, John talked about, we've got 12 commercial properties. We've got interest in almost 5,000 apartment units in the US markets with Venterra. Total value of $205 million. Up in the top corner there, you can see the breakdown between Spire LP and Spire US LP. The original limited partnerships had just a few investors. We now have 360 investors in Spire, $110 million of capital, and 39 investors and $8.3 million of capital in Spire US. That first slide that I showed you, the map of Canada and the United States, shows that we are diversified by geographic location. We are also diversified by sector. And what you'll see here, this is the makeup today of Spire LP. We have about 43% of our portfolio in retail, which is 4 shopping centers from Nanaimo to Calgary to Edmonton to Steinbach, Manitoba. We've got 4 self-storage properties, 1 in North Vancouver, 1 in Richmond, 2 in Maple Ridge. We've got mortgages and REITs, which are for capital that we're waiting to deploy. It enables us to earn an income on that property while we're looking for new investment opportunities. We've got industrial properties in Saskatoon and in Richmond. And then you see there the Spire US LP. It's a small percentage of our overall LP, but it gives investors in Spire LP units a little bit of concentration in the US market. If we split that out a little bit further, this is what is in Spire US LP. And again, it's a snapshot today. We've got the redo office building, commercial building in Seattle, which I'll talk about in a few minutes. And we've got the residential units that John has talked about with Venterra. If we fast forward to the end of the year, this proportion of commercial is going to drop down to about 35%, and the balance will be taken up as of residential because we see good opportunities, and we'd like to own more multifamily residential in the US market. Let's talk a little bit about the team. John spoke. What does John and Nicola Wealth Management bring to the Nicola Crosby team? One thing that hasn't been talked about is that we don't pay anything for the capital that comes in. People are often saying, well, what about this real estate fund, or what about that real estate fund that's out there in the marketplace? Most of those have people out on the street trying to raise capital and paying hefty fees for raising that capital. Nicola Wealth Management is a fee-based firm, so there's no commissions paid for capital that comes in, which means that there's more returns that goes through to the investors. We also, through Nicola Wealth Management, access a portfolio management team, which really serves to keep us on our toes because they're asking the tough questions. They're looking into tenants for us. They're looking into REITs. They're giving us that, that investment perspective, which oftentimes you don't find in a real estate partnership. If we move over to Dave Crosby and Jane Thorne, they're the principal owners of Crosby Property Management, a property management firm that's been in business for over 30 years. They bring to our team assistance in the due diligence process, the asset management, and the property management. Properties that we own locally, they're directly involved. Assets that we own in other provinces, they're supervising the property management firm that's looking after that. Mark Hanna is the managing partner of Avis & Young, a national real estate brokerage firm. Through Mark, we get access to what's happening in the real estate market across the country, opens us to deals, lets us see what's happening in the real estate marketplace, and also enables us to do good due diligence on the properties that we're looking to acquire. I'm down at the end there. I act as the quarterback. I've been in the real estate business, as David said, for over 30 years. I've seen the different cycles. I've come to believe the importance of owning investment-grade real estate, and I'm committed to acquiring only those assets that I'm happy to own, as are the rest of the directors, because we're the first ones to put our money in. This is our real estate portfolio. We don't ask you to put money in and we go put our money in something else. We believe in real estate as an asset allocation, and this is where we put our money when it's invested in commercial-grade real estate. John talked about the 10-year results for real estate. I'd like to just talk briefly about the last 5 years because those are the turbulent years. And there's two things that I'd like to draw attention to. One is the net asset value, and the other is the 5-year rate of return. The importance of the net asset value, that looks at what you pay if you want to buy a unit in Spire. When we started in 2006, it was $1,000 a unit. In 2010, it's $1,030 a unit. You might say, well, that's not a lot of movement, but that's also not a lot of movement up or down. When the real estate markets were, the public markets were moving 100%, we moved 4%. So if you're putting money in, you're paying $1,030 in 2010. If you were taking money out, you'd be paying $1,030. The other thing is to look at the 5-year return. If you'd put $100,000 with us when we started the end of 2005, you'd have a cumulative return of 54%, annualized 9.14%, contrasted to the REIT index of 31%. So $154,000 versus $131,000. Spire principles. What guides us as we move forward and we look at investment opportunities? Partners invest their money alongside investors. That's a core principle for us. When we talk with Venterra, it's really important that our partners have money invested in the properties. We as directors have money invested in the properties. Multiple inputs from smart people as part of the decision-making process. It's a tough market out there. If you're a do-it-yourself investor, you're making a lot of decisions on your own. That's a tough market to operate in. We really surround ourselves with lots of bright people, lots of perspectives. When we come down to making a decision, we've got to answer to a lot of people that are looking from a lot of different perspectives. And also, it's our own money. So we're wanting to make sure that we're preserving capital and we're getting a decent return. Our primary returns come from cash generated by investments. John's talked about that. Both Johns have actually talked about that. We're not looking at inflation as enabling us to get our returns. We're looking from the cash that the investments generate. So if we're in a market that's flat, we're still getting our returns. We're still making those distributions. I enjoy sleeping well at night because I know that my cash flow is coming from the cash generated by the tenants. Minimize volatility through asset selection and long-term capital. I'll get planners coming to me saying, gee, I've got someone that just wants to invest it for a short period of time. I say, I don't want your money. We're looking for investors that have a long-term perspective, that are looking at investing as part of their asset allocation in real estate for the long term. That stability of capital enables us to make purchases in hard assets. We don't have to keep large cash reserves, so we can be fully invested in the hard asset real estate. In terms of the volatility, the sectors that we invest in are those that have shown to be less volatile. When the economy hit the rocks, it was land, it was development opportunities, it was recreational properties, it was those kind of assets that took the hit. The income-producing, cash-flowing commercial real estate took a very little hit. Diversification is a risk management strategy. Talked about diversification by geographic location, but we are also, and by sector, we're also by tenancies, when tenants' leases expire, by debt, when mortgages mature. So we're looking at a variety of diversifications within our portfolio. Transparency, that's really important. Honesty and integrity, we all live here. I've lived here for 55 years. I can walk down any street. I can look anybody in the eye. We deal with integrity. We deal with honesty. We've got a good name and reputation. People want to deal with us because they know that if we say we're going to do something, we deliver on that. We also, for the benefit of our investors and ourselves, we get annual appraisals on each of our properties, and we have an audit conducted at the end of the year. Briefly, our acquisition due diligence, asset selection. We look at hundreds of properties. And we reject the majority of them because they don't fit our conservative outlook. Underwriting, we have our own letter of intent. We go through a thorough process with building condition reports, with appraisals. We look at the tenants. We look at how they, when the leases mature, we look at what's the viability of the business. We look at where it's situated within the marketplace. We've got a long, extensive list that we go through in part of our due diligence. Advisors network. We are operating in provinces and down in the States. It's really important that we have the best expertise in the local market. And that's one of the things that we have really worked to develop over the years. And I think that's why we get good returns in a variety of markets. 10-year cash flow projections. We've got a detailed spreadsheet that looks at all those different factors, does sensitivity analysis to rents, lease renewals, roofing, any rehab that needs to be done. That's all built into our spreadsheet, and we look at the cash flow and how that's going to develop over the 10-year period. Financing and use of leverage. Our overall portfolio has less than 50% debt leverage, so we're conservatively levered. A little bit of leverage is good. Too much gets you into trouble. Unanimous board approval. We go through and make sure that after we've done all of our due diligence, we sit down and we have a look at it and say, do we all want to go ahead with this? And if we all agree, then we move forward. If someone doesn't agree, we got to keep going back and doing more due diligence, or we walk away from the deal. Let's talk about a couple examples. This is Dover Point. It's a retail center we acquired in 2005. It was actually the first asset that went into Spire. It's almost 300,000 square feet. It's called a power center. It's got HomeSense, Winners, PetSmart, The Bay, and Liquor Depot. We acquired the asset. Interesting story, and I don't have time to go into the details, but we actually financed, it was an off-market deal. We financed the developer who was running out of capital. We enabled them to finish the project. We acquired it on a fixed price, fully leased, and we're able to essentially acquire it under market value. The net cash flow hasn't moved up a lot over the last 5 years, but it's been stable. And the principal reduction, the tenants have paid down the debt by $672,000. What does that mean for us? It means that we've had stable cash on cash, and we've had an investment IRR of 14.5%. That 14.5% takes into consideration the increase in the value. Even without any increase in value, we're still 11%. Bray Centre is a shopping center in southwest Calgary. We acquired in June of 2010. We hadn't bought in a retail center since 2006 because the numbers didn't make sense for us. What we liked about this particular one, we liked Tim Hortons, we liked Royal Bank, we liked Fountain Tire, Max, good quality tenants. It's a neighborhood. There's a high barrier to entry. People can't come into this area with new retail development. If we're in a soft economy, it's the bread and butter industries that people really need to continue to require. This center increases our retail portfolio to $521,000, or 521,000 square feet. Solid cash flow, even without leverage, we've got a 7.9% return. Good value add opportunities. Leases were under rent. Want to draw attention to the cash on cash. You look here at 2% and 4.7%. It's starting off with low cash, but we're going to improve the vacancy. There's a 15% vacancy, so we're going to do some lease up. It's been not properly maintained, so we're going to do some capital improvements. So rather than draw in additional capital, we accept a little bit lower cash flow within Spire to bring it up to speed, and you see how the cash flow starts to improve. And our IRR over 5 years is still 13.4%. Better no deal than a risky deal. Why do we not take on some deals? This is an example of, again, in Alberta, strong retail market. It was a new center. It was in a place called Strathmore. Had Sobeys and Walmart as shadow anchors. The cash flow worked. The numbers looked good. It was had good visibility at an intersection in through the property. It looked like it should be something that should be part of Spire. Why didn't we go ahead? There was some vacant space, and we were concerned that it had been overbuilt for the marketplace and that the space wouldn't be leased up. Smaller markets have greater risk. The cap rate was closer to what it should have been in Calgary, and this was outside of Calgary. And there was what I call the potential of dumb capital. There was vacant land across the street, and our concern was that somebody comes along and says, oh, there's Sobeys and Walmart across the street. I'm going to build a new retail shopping center. So we have something that looks good. Now there's competition, and our investment is eroded. So we're looking at not only how it fits on its own, but how it fits within the overall portfolio. Newly acquired Seattle. We like the Seattle market, part of the Pacific Northwest. It's got great growth prospects. But the difficulty with Seattle right now is the office market is overbuilt. So it's going to take a little bit of time to absorb. We acquired this asset in May for $14.5 million. It's got a cash on cash over the next 6 years, 5%, return on equity, 8%, and the IRR, again, double digit. Those are the things that we're looking for. Since acquiring this asset, we've been offered a higher price. We bought it at the right price because the market was down. It's going to perform well for us within Spire US. What are the challenges? REITs have got lots of capital. They're, in our estimation, overpaying for assets because they're really on a growth spurt. We have a conservative outlook. You can hear from both Johns. We don't think that the economy is going to be really strong over the next few years. So we're conservative in our rent projections. We're conservative in our vacancy expectations. So we lose out on some deals right now because we're conservative. But we'd rather not do a deal than do something that we think is risky. So finding deals means looking at a lot of deals. We're committed to doing that because this is our real estate portfolio as well as yours. Opportunities. Briefly, these are 4 that are in the hopper. Jacksonville, Florida closes this week. We're putting in $1.25 million. It's a B+ asset in Jacksonville, Florida. Great cash on cash, starts off at 6%. By year 6, it's up to 11.7%. So great cash flow ramp up. Beaumont, Texas is the one that John Ferresi talked about. That'll be our largest investment. We're committing $3.5 million of Spire into that. We think it's going to be a great asset for Spire. Saskatoon, Saskatchewan, and Winnipeg, Manitoba are examples of what I call boring real estate. But solid cash flow, we're looking at 7.5%, 8% cash on cash returns, 17 to 20% 5-year IRR. There is opportunities in Canada, but you've got to look for them, and you've got to find them either off market. Why invest in Spire? This is what people have told me why they're invested in Spire. Stable and secure income stream, attractive distributions, solid underwriting of assets, low volatility, capital preservation, proven track record, broad asset sector cash flow, and geographic diversification. Thank you very much.